Japan and South Korea just ran a joint dollar-selling intervention, something that almost never happens between these two. On Thursday, both central banks sold dollars at the same time. The yen snapped back from a 40-year low to 157.8. The won jumped nearly 2% to a 9-month high. Yen trading volumes hit their highest in a decade. Markets are calling it historic. It's rare, but it's not a turning point. Japan has intervened alone 8 times since 1985, and jointly with outside partners like the US or G7 5 times. A Japan-Korea joint move isn't in that playbook, this is new. The timing lines up with Fed weakness. A day earlier, the Fed held rates at 3.50 to 3.75%, and traders started doubting the new Fed chair's inflation resolve. That gave Tokyo and Seoul the opening to strike. Here's why it won't hold. The yen is weak because Japan's rates sit near 1% while the Fed sits above 3.5%. That gap is the real story, and selling dollars for a day doesn't close it. By Friday, the yen had already given back some gains. The BOJ held rates steady at that meeting but warned, for the first time, that underlying inflation could run hot, hinting at a possible September hike. That's the actual lever, not Thursday's intervention. History backs this up. The 2024 intervention worked because speculators were heavily short yen and the Fed cut rates months later. Policy and intervention lined up. This time, positioning isn't as stretched and the Fed path is murkier. Without a rate move behind it, this caps the move. It doesn't reverse it. The more interesting thread is Korea. The won had just hit a 17-year low, and analysts note the won and yen are tightly coupled, so this wasn't just about defending the yen, it was about defending a regional FX complex cracking at the same time. Two central banks intervening together usually means neither trusts their own firepower alone. What to watch next, whether the BOJ actually delivers a September hike or just talks about one again, whether US dollar to Japanese yen revisits 160 plus once the intervention fades, ING's base case caps BOJ only intervention around 162 to 165, not a reversal, and whether the Fed's next meeting brings real clarity or more ambiguity. Rate differentials still favor the dollar. This is a speed bump, not a signal to trade on.